This reading is about private company valuation. We'll start out by comparing public companies and private companies. We'll then talk about the major purposes for which private valuations are performed. We'll discuss the concept of earnings normalization, which is very important in the context of private companies. So, for example, with private companies, some of the expenses might be the personal expenses of the owner, and those expenses need to be pulled out to come up with the normal earnings, and then those earnings are used for valuation. We'll talk about the three major approaches to private company valuation, and the last part of this reading is about valuation discounts and premiums. Scope of private company valuation. This is an excerpt from the curriculum. Generally, private companies are relatively small companies, but they are exceptions. You will find some fairly large companies which are private, classic examples being IKEA and Bosch in Europe and Cargill and Bechtel in the United States. We'll talk about the similarities and differences between private and public companies, and then we'll talk about why we perform valuations of private companies. So let's start with the similarities and contrasts. Broadly speaking, we have company-specific factors and stock-specific factors. So let's look at company-specific factors first, and I'll simply go down the list given in the curriculum. And remember, we are talking about public companies versus private companies. Generally, private companies tend to be earlier in the life cycle relative to public companies. If you want more details on this, the curriculum is there for you. What I'll do is just say the one or two lines that you need to know about each of these items. And everything that I say is a generalization. Obviously, you can have some private companies that are later in the life cycle, but by and large, private companies tend to be relatively young compared to public companies. Size, again, private companies tend to be relatively small. Overlap of shareholder and management. Generally, in private companies, the owners and managers are the same, whereas in large public companies, there is a separation of shareholders and management. Quality and depth of management. Generally, in public companies, you will have higher quality management because public companies can pay more, there is more stature, so they can attract high quality talent, whereas in private companies, it is more difficult to attract high quality management talent. Quality of financial and other information. Public companies by definition need to meet listing requirements, they need to meet standards such as IFRS or US GAAP. So the quality of financial information will be much better for public companies relative to private companies. Pressure from short-term investors. Public companies, listed companies are constantly under pressure to keep reporting good numbers. Private companies don't face those sorts of pressures. Tax concerns. While tax concerns apply both to private companies and public companies, but generally speaking, private companies will be more concerned about maximizing cash flow as opposed to trying to show high earnings. Now coming to stock-specific factors. Liquidity of equity interests in business. Clearly, if you are a shareholder in a publicly listed company, your shares are much more liquid than, say, if you own a 10% stake in a private company. Concentration of control. Generally speaking, in a private company, the control will be concentrated in an individual or in a particular family that owns that business. Potential agreements restricting liquidity. It is possible that in a given private company, you have a 15% stake, but it is not possible, at least legally in the short run, for you to sell that 15% stake. So you might have gotten that stake with a constraint that at least in the near term, you are not allowed to sell that share. So this is more likely to happen in private companies relative to public companies. Reasons for performing valuations. The curriculum gives three broad categories of reasons: transaction related, compliance related, and litigation or law related. The reasons that will interest us the most as analysts are transaction related. So what are those reasons? One is private financing. Let's say that a private company wants to go out to private investors and raise some money. So clearly, when a private investor is giving money, the private investor wants to know that if I am giving $5 million, what percentage of the company will I then own? And how do you figure that out? You have to come up with the value of the company in order to figure out whether 5 million gives him 20%, 30%, or 40% of the company. So important from a private financing perspective, important from an IPO perspective. So you have a private company that is preparing to go public. Clearly, you need to do a valuation of that private company. Then acquisitions. Obviously, when a company is acquiring another company, then all the stakeholders or the relevant stakeholders will be interested in the value of the company being acquired. Bankruptcy. Let's say a company is going into bankruptcy or is in bankruptcy. You, as an analyst who is evaluating the company, might want to figure out whether the company is more valuable simply based on the value of assets minus value of liabilities, or is it more valuable when you look at the present value of future cash flows? Because if it is more valuable in terms of value of assets minus value of liabilities, then it makes sense to liquidate. But if you perceive that on a going concern basis the valuation is higher, then you would advise the company to go into maybe bankruptcy short term and then try to emerge out of bankruptcy without liquidating itself. Share-based compensation. Certain private companies do compensate executives based on the value of the company. Since the company is not publicly listed, there needs to be another mechanism of coming up with the value. So there again, we need to perform valuation. Compliance related reasons, financial reporting. Now, something that you have studied is that there are several reasons why we might want to value from a financial reporting perspective. A classic reason is to check whether there is any goodwill impairment or not. So a company has recorded some goodwill. How do you figure out whether the goodwill is impaired or not? The way you do that is by coming up with the overall value of the company and determine whether the amount of goodwill is justified or not. Also, for tax related reasons, it at times is necessary to do valuations. And then I won't go into these litigation or law related reasons, but you can just look at this list over here: shareholder disputes, damage claims, lost profits. If there's a divorce and husband wife need to get 50%, 50%, question is 50% of what? So clearly some form of valuation needs to be done. Which applications are of greatest interest to financial analysts? As I indicated earlier, it is this category. And then within this category, the one that comes up most often actually is acquisition related. So all are important, but I'd say from a financial analysis or financial analyst perspective, this is the one that you might see most often. We've talked about the reasons for valuing private companies. Now we will look at valuation approaches. There are three major approaches to private company valuation. One type of approach is the income approach. This approach values a company as the present value of its future cash flows. So this can be compared to the present value models that we discussed in the context of public companies. Then we have the market approach. This approach values a company based on pricing multiples from sales of similar companies. So other companies that are private companies or even public companies that have been sold, we will look at how much that company was sold for relative to, let's say, revenue or earnings, and then use those multiples to estimate the value of our target private company. We can say that this is comparable to the multiples approach that we discussed in the context of public companies. And the third area or the third category is the asset-based approach. This approach values a company based on the value of assets less the value of its liabilities. So, companies where a large percentage of the value is coming based on its assets, for this sort of private company, it makes sense to use an asset based valuation. Let's start with the concept of normalized earnings. Here is a definition from the curriculum. Normalized earnings are economic benefits adjusted for non-recurring, non-economic or other unusual items to eliminate anomalies and or to facilitate comparisons. So what does this mean? Examples would be any non-recurring unusual items, discretionary expenses, non-market compensation levels, personal expenses. So when you are evaluating a private company and the CEO should have a salary of say 200,000 given the sort of company and the sort of work, but is actually paying himself 400,000. Is there anything inherently wrong with that if the CEO is also the 100% owner? Then there is nothing inherently wrong because he is the owner, manager, he's everything. So if he wants to pay him twice as much, so if he wants to pay himself twice as much, that's okay. But if you are buying this company and evaluating what the normalized earnings should be, then does it make sense on a going forward basis to use the market compensation of 200,000 or the compensation the guy is actually paying himself? You should actually use the market compensation. And adjustments like this need to be made. After adjustments, you have an earnings number that is called the normalized earnings number. This discussion is best understood through examples, and I will just set the context here because we are going to talk about able manufacturing, and this will flow through several examples. The overall scenario is this. You have a manufacturing company called Able, and I'm giving you these names because they'll keep coming up, so just remember the names. Able is the name of the company. The current shareholder and CEO is John Smith, and the person who is doing the analysis of this company is James Duval. So the analyst is Duval. You are putting yourselves in Duval's shoes. So remember the names now. In example 1, the emphasis is on coming up with the normalized earnings. So you can pause the video and read through this, but I'll just summarize the main points. Smith, who's the CEO, has a compensation of 1.5 million. That's how much he's paying himself. But the appropriate compensation for a CEO of a company of this size and this nature is 500,000. All right, so does this immediately tell you that some normalization needs to take place? Yes. You might also be thinking that if you look at the income statement, where would you make the adjustment? The answer is in SG&A. So you are told that the salary item is a component of SG&A. So that clearly is one adjustment. Also, the CEO has ranch and condominium expenses of 400,000. These expenses have nothing to do with the business itself. But for some reason, maybe tax reasons, the expense is being included in the income statement. Of the 400,000, do you think it's important to understand how much is cash and how much is non-cash? It is. The cash part is 300,000 and the depreciation, which is non-cash, is 100,000. And then there is a comment related to the debt balance, which is not relevant now but will be useful later. You are given this financial statement. This is the operating income before any adjustment. And what you need to do is estimate the normalized operating income. So this is before interest, before taxes. What is the normalized operating income? And I'll just summarize the points for you so you can attempt to come up with the normalized number before looking at the solution. Remember, the compensation was 1.5 million, but should be 0.5 million. And this is included in SG&A. The other adjustment is that there are condominium and ranch expenses of 400,000. of which 300,000 are cash expenses and 100,000 are non-cash depreciation expenses. So given these numbers, come up with the normalized operating income. In fact, you can just come up with a pro forma statement where the bottom line is the normalized operating income. So this is what you need to come up with. The revenue number is not impacted. The COGS number is not impacted. So if you look over here, the COGS number is still the same. What happens to SG&A? So SG&A is down. So earlier it was 5 million. So what's the adjustment? You take away the 1 million compensation, and then you also need to take away the 0.3 million. So that's why we come to from 5 down to 3.7 million. And then there will obviously be a different EBITDA. The depreciation earlier was 1 million. That actually now becomes 900,000 because 100,000 was depreciation related to the non-business related condominium and ranch. So when you do your calculations, given the same tax rate of 40%, the operating income is 9,240,000. So this is the normalized operating income. And why do you think we are focusing on the normalized operating income? The reason is that if this company is bought, then the leverage might change, the tax rate might be different. So here we have, this is an important number. The earnings before taxes are this number. Then we subtract taxes at 40% and come up with operating income after taxes of this number. We've talked about normalized income. Now we will cover cash flow estimation issues for private companies. And this is fundamentally very similar to what you have seen earlier in the reading on free cash flows. In addition to earnings normalization, cash flow estimation is an important element of the valuation process. Free cash flow is the relevant cash flow concept in this context. Represents free cash flow at the business enterprise level and is used to value the firm or indirectly the firm's equity. How would you do that? By coming up with the overall value of the firm and then subtracting the value of debt. Alternatively, free cash flow to equity can be used to value equity directly. So we continue with able manufacturing, and now what we are going to do is come up with the pro forma free cash flow. We already have the normalized earnings. Now let's come up with free cash flow estimates. We know that the debt is 2 million. The example gives a lot more text. I have just pulled out the relevant data. So we are told that the long-term growth of revenue and after-tax operating income is 3% annually. So what does this tell us? This tells us that we can now use the Gordon growth model. So there's going to be a growth rate of 3%, which is sustainable. We are told the gross profit margin is 40%. How will this help us? As long as we can project sales, we can then project COGS, and then we can project gross profit. Depreciation will remain at 1.8% of sales. So this again is convenient. As long as we know sales, we know depreciation. SG&A expenses can be maintained at the prior year's level of 3.7 million, at least for 2 years. So we are being told simplistically that this is the SG&A. Working capital equal to 10% of revenues is required. So we are given the working capital requirement. We are told that capital expenditure will be equal to the depreciation amount. So in other words, to maintain the equipment, we need to actually spend money equal to the depreciation amount plus 5% of incremental revenue. So based on this, there are two questions. First of all, should the analyst, this is you, use reported earnings or normalized earnings? And then the second is to actually come up with the FCFF. So obviously it makes sense to use the normalized earnings, because the perspective is that of a company which is taking over Able. If you take over Able and hire a CEO, will you pay the CEO 1.5 million or 0.5 million? You will pay him 0.5 million. If there is this non-operating ranch and condominium, will you keep that or will you sell it off maybe to the original CEO, Smith? You will obviously get rid of that because that has nothing to do with the company. So you actually need to use the normalized earnings as your starting point. Then let's come up with the FCFF. I won't spend much time on this because if you are asked a detailed question on FCFF, it is much more likely to show up in the context of the FCFF reading. But this is simply a numerical representation of the information that is given. So you have revenue. How is this COGS coming? It is based on the 40% ratio. So the gross profit is easy. SG&A is maintained. So that's this number. So you come up with EBITDA. Depreciation, you are told, is 1.8% of sales. So that's easy. Then so you can come up with EBIT. You can come up with your operating income. Why do you add back depreciation and amortization? Because it is a non-cash charge. And then you are coming up with cash flow. So you subtract the capital expenditure, which is based on depreciation, plus 5% of incremental revenue, which was given. And you also subtract the increase in working capital, which is 10% of the incremental revenue. So purely based on numbers given, you come up with the FCFF. All right. We have talked about normalized earnings. We've talked about coming up with FCFF. Now, what are the various approaches for actually coming up with the value of the firm? Here you will see terms and concepts that should look quite familiar. There are three forms or three types within the income approach. And at a high level, we'll talk about an income approach and then a multiples-based approach and then an asset-based approach. Here we are on the income approach. Within the income approach, there is something called the free cash flow method, which is also called the discounted cash flow method. Then we have the capitalized cash flow method and the residual income method. The residual income method in the context of private companies is sometimes called the excess earnings method. So let's say you come up with these cash flows. We've already come up with the free cash flow. Then how do you arrive at value? You need to discount. To discount, you need the discount rate. Do you think it is easy to come up with the discount rate? The answer is it is not. Even for public companies, the discount rate is an estimate. In a public company, what's the most popular way of coming up with the discount rate? By using the capital asset pricing model. Can you use the CAPM over here for a private company? You can, but there are challenges. So specifically, what are the challenges in coming up with the discount rate? Those challenges are listed over here, and each one of these is explained in the curriculum, but I'll give you the most important points. Generally, private companies are small companies. So if you recall, for small companies, often we add a size premium. So will this be an addition or a subtraction? It will be an addition. So small companies, you will add a size premium. The use of CAPM. Now, if you think about CAPM, an important aspect of CAPM is the beta. And how do you come up with the beta? You basically run a regression of the company return against the market return. But with a private company, the company is not publicly traded. So you will have to rely on comparable public companies. And even if you come up with a beta using comparable public companies, how confident are you that that beta really represents this company? Not very confident. So you could use CAPM, but there will be several questions related to the discount rate that you come up with. What is often done in practice is that we use an expanded CAPM, where we consider factors such as the size premium and so on. And we are going to actually do an example related to expanded CAPM. Another model is to use the build-up approach, where you have a starting point, such as, let's say, the risk-free rate, and then you add various premiums or premia on top of that initial number. Other issues include relative debt availability and cost of debt. So if you are coming up with the overall cost of capital, then you need the cost of debt. The question is, how easy is it for this private company to raise debt capital? And if it does raise debt capital, then what will the cost of debt be? Okay, discount rates in an acquisition context. Okay, so the point here is, if you are a large company acquiring a small private company such as Able, which discount rate do you use? Do you use your own discount rate, your own being the discount rate of the large company? Or do you use a discount rate associated with the riskiness of the cash flows of the company that is being acquired? The answer is the latter. You have to actually use the discount rate associated with the riskiness of the company that's being acquired. Discount rate adjustment for projection risk. If you are acquiring a company and it is hard to project the cash flows, does that increase the level of risk? Yes. Does that mean you need to adjust the discount rate accordingly? Yes. So if you think about it, coming up with the right discount rate involves a fair amount of judgment, and it's not that easy. Okay, now in example 3, we continue with Able, the manufacturing company, and we will now estimate the discount rate using different methods. I have reproduced the relevant information over here. So we are given the risk-free rate, we are given the equity risk premium, the beta, which seems close to 1. We are given the small stock premium of 3%, the company-specific risk premium, industry risk premium here we are saying is 0%, and the pre-tax cost of debt. These are the numbers that we are going to use initially. What is the required return based on CAPM? Is that easy? So the CAPM number will be fairly straightforward. It is your risk-free rate plus 1.1 into 5. So that is easy. What about the expanded CAPM? Now, since I have not explained this before, I'll just show you what we do with expanded CAPM. That is right here. Expanded CAPM in the context of a small private company does the following, right? You start with the risk-free rate, and then what's this 5.5? This is simply the beta of 1.1 multiplied by the equity risk premium. So up to this point, we have regular CAPM, and then these two represent the expanded part of the expanded CAPM. There is a small stock premium of 3% which is added, and then the company-specific risk adjustment. So according to expanded CAPM, the required rate of return should be 14.3%. So what are the points to remember here? The first point to remember is that your starting point is CAPM, and to CAPM you add the small company premium, and to CAPM you add the small stock premium and the company specific risk premium. You do not add the industry premium, the industry risk premium. In this case, the industry risk premium is 0, but even if it were not 0, in expanded CAPM you do not add it. The reason is an assumption or an implication that the variation in beta from 1, so beta is not 1, it's close to 1, but it's not 1. The difference from 1 captures the industry related risk. That is the assumption. Now, just to highlight that point, let's also look at the build-up method. What do we do here? So again, start with the risk-free rate. That is the first item. And then you add the equity risk premium. But this is not adjusted for the beta, right? So that is a big distinction between the expanded CAPM and the build-up method. So there is no beta adjustment. The small stock premium is there. So is this the same as what we saw with expanded CAPM? Yes. You add the industry risk premium. It happens to be 0 in this case, but if it were not 0, if it were 0.6, then you would actually add 0.6 in the build-up method. You do not add 0.6 in the expanded CAPM. And then the company-specific risk adjustment, this happens both with expanded CAPM and the build-up model. So make sure you understand the distinction between expanded CAPM and build-up. And to summarize the two major differences, with expanded CAPM you use beta, with build-up you do not. And the other one is that with expanded CAPM you do not use the industry risk premium, but with the build-up method you do add the industry risk premium. Questions 4 through 6 over here take us in a slightly different direction related to the weighted average cost of capital. Obviously, to come up with the weighted average cost of capital, you need to make an assumption about the weight of debt relative to equity, and you also then have a question about the cost of debt. And you can read the details in the curriculum, but I'll emphasize the main point here. So let's look at this information. We have a pre-tax cost of debt, and then we are told that the ratio of debt to total capital for public companies in the same industry is 20%. So in this particular industry, debt optimal level is 20%. The optimal ratio of debt to total capital for this company, for Able, is estimated at 10%. Does it make sense that for a small private company, the optimal level of debt is less than the optimal level of debt for larger public companies? The answer is yes. So when we are coming up with a WACC for the future, should we go with 20%, which is the industry standard essentially, or should we go with 10%, which seems to be the optimal number for Able? Answer is we should go with 10%, which is the optimal number for Able. But currently the actual debt ratio is 2%. So does this mean that the entity which will acquire Able can increase value by taking on more debt? The answer is yes. This is something that we studied in corporate finance, that if a company is not at the optimal capital structure, then it makes sense to move towards the optimal capital structure. So this easily is a question on your exam where you are given information like this, and your question is that post-acquisition, what is the most likely target capital structure? Is it 20% debt, 10% debt, or 2% debt, given based on the three numbers given here? And the correct answer would be 10%. All right, so what have we done? We have talked about normalized earnings. We have talked about free cash flows. We have talked about coming up with the discount rate. Now the next step is to actually value the company by using the cash flow and the discount rate. In the context of this reading, the two methods that we talk about here are the free cash flow method and capitalized cash flow method. The free cash flow method values an asset based on estimates of future cash flows that are discounted to present value by using a discount rate reflective of the risks associated with each cash flow. For a going concern, this method frequently includes a series of discrete cash flow projections followed by an estimate of the value of the business enterprise as a going concern at the end of the projection period. So this sounds exactly like the free cash flow valuation that we have talked about before in the reading on free cash flows. So you come up with the free cash flow at the end of period 1, period 2, period 3. Let's say this is your terminal year. Then you come up with a value of the firm over here and you discount all the numbers. The next one, capitalized cash flow method. All this is doing is applying the Gordon growth model. So with this model, we say that we know the free cash flow at the end of period 1 and then discounted by WACC minus the growth rate. So this exercise of taking a cash flow and dividing by something in order to come up with a value is called capitalization. And earlier we called this the free cash flow model with using the Gordon growth formula. Here in this context we are calling this the capitalized cash flow method. So the name has changed, the concept has not changed. If you come up with the value over here, is this the value of the firm or the value of equity? This is the value of the firm, and then to come up with the value of the equity you have to subtract the value of debt. Let's look at example 4 now, valuation using the capitalized cash flow method. So this is our estimate for the free cash flow at the end of year 1. This is a forecast number. The first question is explain the rationale for using the capitalized cash flow method. The rationale is that we are assuming a constant growth rate of 3%. So we can use the Gordon growth model, which in this context is called the capitalized cash flow model. Then in question 2, you are asked to calculate the value of equity using a 13.1% rate. Then you are asked to calculate the value of equity using a WACC of 13.8. So I'll just ask a quick question and then make you do the calculation. Which value will be higher, the value using 2 or 3? And the answer clearly is the value will be higher when we use a lower cost of capital, i.e. 13.1. So now pause the video and do the calculations. Here is what you should come up with, and this actually has been reproduced from the curriculum. I'll just explain what they're doing. The cost of capital that we use in part 2 is 13.1%. The long-term growth is 3%. So this is the denominator in the Gordon growth model. 13.1 minus 3, which is 10.1. That 10.1 is called the capitalization rate because you are taking your cash flow and dividing by 10.1 in order to come up with value. You are actually dividing by 0.101, which is the decimal form. So the value of invested capital is this number over here, 92 million. And then you subtract the value of debt, which will then give you this value for equity. When you use 13.8%, the calculation is similar, but the value of equity obviously is lower. The third income method, remember with the income method, we said that there are 3 ways of doing this. The first was free cash flow, where we look at the individual free cash flows and discount back. The second is the capitalized cash flow, which is essentially the Gordon growth model. And then the third is excess earnings method, which essentially is the residual income method. Excess earnings equal normalized earnings minus the cost of capital times tangible assets. So this is like the EVA formula that we saw in the previous reading. When we do this, what we come up with is the value of intangible assets. And the way you can think of this is, a private company has tangible assets, and those tangible assets obviously have some book value, but is the value of the firm the same as the book value of the tangible assets? It's not, it's more than that. Why? Because of the intangible assets. So to estimate the intangible assets, you look at the excess earnings being the earnings minus the capital charge, which is this number. And if this number is high, that means that the intangible assets are high. So the total value then becomes equal to the value of tangible assets plus the value of intangible assets from here. This method, the excess earnings method, has been used to value intangible assets and very small businesses when other methods are not feasible. The curriculum actually mentions that this method is hardly ever used. It's only that if you don't have other options and a given company has a high amount of intangibles, then for small companies you might use this method. And then the curriculum goes on to describe a 7-step process where this method is explained in detail. Given what the curriculum says about this method, I think that what I have said here is sufficient. The probability of this showing up is relatively low, and if it does show up, then most probably what I have said here should suffice. Market approach methods. You will notice a lot of overlap between the material here and what you have seen in corporate finance. Here are the market approach methods. The first one is called the Guideline Public Company Method, or GPCM. The estimated value of a company is based on multiples of comparable public companies, and then the multiples are adjusted to reflect differences in the relative risk and growth prospects. So we will continue with able manufacturing and look at examples of how to apply this particular method. Then we have the guideline transaction method. So in the guideline public company method, you look at the multiples in the market. So these multiples would be based on the share price or the market value of debt and equity. The guideline transaction method is such that the estimated value is based on pricing multiples derived from the acquisition of control of entire public or private companies that were acquired. So here we take the overall company perspective. What if the overall company is bought? Then what multiple is to be used? Whereas GPCM uses a multiple that could be associated with trades of any size, the GTM, or guideline transactions method, uses a multiple that specifically relates to sales of entire companies. And then this method, I think, is less important, prior transaction method. This considers actual transactions in the stock of the subject private company. So if there have been transactions in the past where, say, 10% of the company was sold, then you look at what was the valuation associated with that transaction. All right, so we continue with able manufacturing, and let's just take it as a given that the relevant multiple is this thing called MVIC to EBITDA. MVIC stands for the market value of invested capital. So simplistically, that is the market value of debt plus the market value of equity. And what we are saying is that the MVIC to EBITDA multiple of comparable public companies is 7. All right, so we find companies that are somewhat like able manufacturing. We find their market value of debt, market value of equity, add the two, that gives us MVIC, and then we divide by the EBITDA, and on average the multiple is 7. Now this is for publicly traded comparable companies. Able obviously is a small manufacturing company, so should the multiple for Able be higher or lower or the same? The answer is the multiple should be lower. Why? Because clearly this is a riskier firm. So in terms of multiples of EBITDA, this relatively risky small private firm should trade at a lower multiple. Another way of putting it is that for Able, we can only justify a lower multiple. The question tells us that approximately we need to apply a discount of 15%. And when we apply a discount of 15%, we come to roughly 6. The exact number is 5.95, but we round it off to 6. So what are we saying? We are saying that we will use a multiple of 6 to value Able. Then we are given this point. A control premium of 20% was reported in a single strategic acquisition from several years ago. The transaction involved an exchange of stock with no cash consideration paid. Okay, now this is a bit of a trick over here. We are told that the appropriate multiple is 6, and a question is that when somebody buys able, in the price that is paid, should there be a control premium? Okay, so this is a tricky question. As in, should there be a control premium or not? And then if so, then what should the control premium be? Look at the statement over here. And also look at the fact that if you actually follow the case carefully in the curriculum, the buyer is not a strategic buyer. The buyer that is considering, so Duval is not a strategic buyer. This point over here, there are some important adjectives that you need to look out for. This is a single acquisition, so it only happened once. It was a strategic acquisition, and it happened several years ago. None of these adjectives apply to the current transaction being discussed. So while the principle of a control premium does make sense, but probably not 20%. And unless there is a good reason to do otherwise, we here are actually not going to use the control premium. We will talk about control premium though in more detail in a later section. So Duval, who is the buyer, is not aware of any strategic buyers that might incorporate synergy. So if Duval is buying and then selling to another entity, he's not aware of any other entity that will have synergies. All right, we are given the normalized EBITDA number, and we are told that the market value of debt is 2 million. Explain the elements included in the calculation of a pricing multiple. And then we calculate the value. So I'm actually going to show you how this works. Here is what's going on. The pricing multiple based on comparable companies is 7. And then we said that we apply a 15% discount, which gives us 5.95, and that is rounded off to 6. We are told that the normalized EBITDA is 16.9 million, and it makes sense to use normalized EBITDA because when a company acquires, obviously it is going to pay a market salary, not the extra 1.5 million, and also the condominium and ranch will be sold off or gotten rid of. So we use the normalized EBITDA, we use the pricing multiple, and when you multiply the two numbers, what do you get? You get the value of invested capital. Then what is the value of equity? You subtract the value of debt to then get the estimated value of equity. So it is a fairly straightforward calculation. All right, next we come to the guideline transaction method. In addition to the income approach and the guideline public company method, the guideline transaction method was considered and applied. So what was noticed over here? Pricing multiples from several recent transactions of private companies in the industry indicated a ratio of 6. All right, so here already we are given the ratio. Several of the acquisitions studied were viewed as similar to Able because of similar revenue bases and limited diversification. The overall risk and growth characteristics of the acquired companies and Able were viewed as similar. So what does this tell us? This tells us that we can be reasonably comfortable using a multiple of 6 without any adjustments. So we can actually read through this information, but the calculation is straightforward. Again, we take EBITDA, multiply by the pricing multiple, come up with the value, subtract debt, and this is the indicated value of equity. So quite simple. Asset-based approach, and this is easy. The underlying principle is that the estimated value is the fair value of assets less the fair value of liabilities. But this approach is seldom used for going concerns. Why? Because generally there will be limited data available to value intangible assets. And second, even certain tangible assets such as property, plant and equipment will not be easy to value. So for a manufacturing company, especially if some special purpose equipment is being used, it is not easy to come up with the value of that equipment. The asset-based approach is appropriate when a given company is winding up operations, so you want to come up with a liquidation value, or if you are valuing a holding company where the underlying companies are largely, or the value of the underlying companies are based on the assets that they hold. So if you think about REITs, for example, which we'll study in alternative investments, you can come up with the market value of the underlying assets, and then the value of the holding company is simply based on the net asset value, which value of assets minus value of liabilities. Valuation discounts and premiums. Now, I would say that of all the items that we've studied in section 4, almost everything should look very familiar. It is material you've seen before with slightly different names. This is perhaps what is a little bit different that you haven't seen earlier. Valuation discounts and premiums. Clearly, when you are dealing with private companies, you need to worry about certain discounts and premiums that do not apply in a public company context. I have already mentioned this concept of a control premium. What does this mean? When you are buying a company and you will have control and the ability to make changes, then it is possible that you pay a premium over the calculated price because of that control. And that premium is very appropriately named the control premium. The opposite of a control premium is discount for the lack of control. If you have calculated a value which is the value based on a total acquisition, so based on, let's say, the transaction method, you arrive at a value of 100 million, but this 100 million assumes control. And you are only buying, let's say, 10% of a company. As a 10% shareholder of a private company, you do not have control. If the overall value is based on the assumption that there is control, but you are getting a stake where you do not have control, then should you pay 10 million or you take 10 million as a starting point and reduce the value because you don't have control? And the answer is that's what you should do. You should reduce the value because you do not have control. And what is that discount called? It is called the discount for lack of control. So what is the relationship between the control premium and the discount for lack of control? This formula gives us the relationship. The discount for lack of premium is 1 minus 1 over 1 plus the control premium. If we assume the control premium is 0.2 or 20%, then the discount for lack of control would be 16.67%. So the point being that given the control premium, you can also calculate the discount for lack of control using this relationship. Now, I think this is probably what is most testable. Let's say that you have calculated the value of a company given the guideline transaction method. Then the value that you come up with is based on a control perspective by definition. And you have a non-controlling stake. Should you apply the discount for lack of control? The answer is yes, that is what I have been discussing over here. What if the guideline public company method has been used? Then if you think about it, the market value of equity and market value of debt for comparable companies is based on what is happening in the stock market or the bond market. And that is not based on a controlling interest. When you look at the value of equity in the market, that is based on small transactions, not a controlling interest. So the basis of valuation is already typically a minority perspective, and therefore it does not make sense to apply the discount for lack of control. What if we are using the free cash flow method? Then the basis could be either control or minority, depending on your assumptions, and whether or not to apply the discount for lack of control really depends on the situation. There is also the concept called discount for lack of marketability. This is an amount or percentage deducted from the value of an ownership interest to reflect the relative absence of marketability. What does that mean? Let's say that you buy a 10% stake in a private company. Do you think you can easily take that 10% stake and go sell it? You cannot. So your ownership stake is there, but it's not very marketable. And because of that, you will require a discount when you buy. We continue with our example of able manufacturing, but there is a slight twist now in the example. We have another player called Jane Doe, and given that we are talking about control and not control, so this additional character now is the minority owner. She owns 10% of Able. So same company, Able, this has two shareholders. 10% ownership is with Jane Doe and 90% ownership is with John Smith. And Duval is still the person who is doing the analysis. With this particular company, we have two scenarios right now. The transaction is being discussed. So what are the two scenarios? One is that the transaction being discussed actually goes through, and the other possibility is that there is no transaction, that the transaction falls through. And in this question, we'll try and understand the value of Jane Doe's investment, her 10% investment in both these scenarios. So this is the additional data. I'll just explain this data and then talk about why the numbers are what they are. Valuation discount assuming the imminent transaction. The lack of control discount is 0%, lack of marketability discount is 5%. The other scenario is assuming continued operation as a private company. In other words, the transaction doesn't go through. Here, the lack of control discount is incorporated through the use of reported earnings rather than normalized earnings, and the lack of marketability discount is 25%. We are also given the value in the two scenarios. If the transaction goes through, which is called the sale scenario, the value is 96 million. And if the transaction doesn't go through, then in the stay private scenario, the value is 80 million. So at a high level, let's first talk about the big difference between these two numbers. Why do you think there is a difference? The answer here is, if you recall, that in the stay private scenario, the CEO is paying himself a very high salary above market level, and then the company is also taking on expenses related to the ranch and the condominium, which really should not be there. So do you think those extra expenses bring down the value of the company? The answer is yes, they do. That's actually the main reason. The other might also be leverage, in the sense that if the company is taken over, then there will be more debt, the capital structure will be made more optimal, and that would also increase. But I think the bigger factor here is coming from the normalized earnings, because there is a substantial amount of money being spent where it ideally should not be. All right. Now, let's come to why we have a lack of control discount of 0% if the transaction does happen. If you think about it, the CEO and the current owner Smith will negotiate a deal such that the value or the amount he gets is maximized, right? So he wants the company to sell for as much as possible, and when he does that, automatically Jane Doe will also get the maximum amount for her 10% stake. So that's why there is no basis for Jane to complain that she doesn't have control, therefore, or there is no reason for giving or having a lack of control in that context, because this value is the total transaction value, and Jane will get 10% of this number, so the lack of control doesn't even come up. What about lack of marketability discount? So for a minority owner, should this apply? So I want you to come up with the value of Jane Doe's 10% stake, assuming that the sale scenario takes place. So assuming the sale happens, how much will Jane Doe get? The correct answer will be 9.12 million, because we take 10% of 96 million, which is 9.6 million. We are told that there is no lack of control discount, and we've talked about that. But there is a lack of marketability discount. So we actually subtract 5% from 9.6 million, and that gives us 9.12 million. What about the other scenario? In the stay private scenario, what is the value of Jane Doe's 10% stake? Come up with the number before looking at the answer. The correct answer here, if we assume the stay private scenario, then the starting point is 8 million, which is 10% of this number. And then we are told that there is a lack of marketability discount of 25%. So that then means that she gets 8 million less 25%, which is 6 million. Here is another interesting point. Lack of control discount. This is incorporated through the use of reported earnings rather than normalized earnings. What does this mean? Jane Doe does not have control, because of which she cannot stop the CEO from taking extra salary. She cannot stop the CEO from his, from the investment in the ranch and the condominium. So automatically, because she doesn't have control, she loses out on cash flow. And that discount is reflected in the fact that the stay private scenario has a company value that is much lower. We have now come to the end of this reading. Let's summarize the key points. The first major point has to do with the differences between public and private companies. The differences can be company specific as well as stock specific. So when we talk about company specific factors, generally private companies tend to be smaller. They are relatively early in their life cycle. Also, with private companies, the depth of management is generally low. And with everything I said, the opposite holds true with public companies. And these are general guidelines. As far as stock-specific factors are concerned, generally public company stock tends to be more liquid, whereas private company shares tend to be less liquid. With private companies, the concentration of control tends to be higher. And with private companies, there might also be potential agreements which restrict liquidity. Private company valuations are typically performed for three different reasons: transactions, compliance, or litigation. And for financial analysts, generally the most important reason is transactions. So this has to do with the buying and selling of private companies, and then obviously we need to figure out the value. We've talked about normalized earnings, and this refers to making adjustments to earnings so that we remove factors such as costs that are not really related to the company. And when we value a company, we should use normalized earnings. On the exam, if you are asked to value a company using free cash flow, then obviously you will have to calculate free cash flows. But the good thing is that with private companies, the questions that you get with respect to them, you will generally be told how to come up with the free cash flow. And then as far as valuing the company, the valuation will be based on the present value of the free cash flows, and then there will also be a terminal value that you might have to calculate, and then you will have to discount back the terminal value. Another approach is to use capitalized cash flow. So this is another way of valuation, and this would involve coming up with a cash flow in period 1 and then dividing this by a capitalization rate, and that will give us the value. So this is the simplest way of coming up with a value. And then we have a residual income method. With residual income, what we do is start with normalized earnings, and then we reduce the cost of working capital. So the return on working capital and the return on fixed assets is removed, and there are a few more steps that we have discussed in the regular lecture. With market-based approaches, we can use the guideline public company method or the guideline transaction method, or we can use the prior transactions method. With the asset-based method, we look at the market value of assets and subtract the market value of liabilities. We also talked about the control premium and discount for lack of control. When we buy a private company and we have control, then we pay a little extra for that control, and that little extra is called the control premium. If we buy only a share of a private company and don't have control, then we will get a discount for lack of control. Similarly, if we have a share in a private company that's not marketable, so it's not easy to sell, then there should be a discount for lack of marketability. So those were the major points. As always, I want you to practice as much as possible. So go over the examples in this reading, do the practice problems at the end of the reading, and also do the practice problems that are provided by IFT. That is it. Best of luck.